right time to comment on the next Bank of Japan governor. After the BOJ, he was out again saying that they will leave monetary policy to the BOJ. Japan's top currency diplomat Kanda said they are closely watching market moves. Funny that they're saying it on the other side of the fence now rather than when yen was weakening. There we go. RBA minutes were out overnight and they showed that the board considered hiking by 25, 50 or pausing at the December meeting. I hope they don't get splinters sitting on that fence. The board saw arguments for each option, but 25 pip hike had its strongest case. The range of opinion of options for the cash rate will be considered in coming meetings, and the further rise in rates likely to be needed to balance supply and demand in the economy. The board had noted that no other central bank had yet paused its tightening, and they're ready to return to larger hikes if needed or to leave rates unchanged for a period. So as mentioned, well on the fence there with what they're going to do next. ECB's Nagel said it will take a while to return to 2% inflation. They might be getting there a bit quicker than expected. German PPI was out for November. 28.2 came out year on year versus 31.1 expected, down from 34.5% prior. That's year on year. On the month, it fell 3.9%, so more than the minus 1.7% expected. Over in the EU, they're still, well, apparently they're getting closer to this gas price cap that they have agreed now. That the gas price cap will be set at 180 euros. The price cap will not initially apply to over-the-counter trades. Don't ask me why. And they will suspend the price cap if margin calls significantly increase. One has to wonder why they're bothering with it at all. It's going to be triggered from February the 15th onwards and likely to stay in place for around a year. I really don't know what this cap is hoping to achieve, because the conditions by which they don't use it seem to be growing daily. But there we go. That's the EU for you. Over in Canada as well, there was some inflationary data as well. PPI 2 year on year, it dropped to 9.7% from 10.1% prior. On the month, down 0.4% as expected. Prior was up 2.4%. The raw materials prices also dipped year on year to 8% from 8.6%. Not long after Bank of Canada's Macklin was out in a press piece saying that they missed the mark on rising inflation, but a turnaround is near. They also increased operations in their overnight repo program, increasing to 1 billion for each eligible participant. But at the same time, they've got this thing called the maximum aggregate cash value limit that would increase to 5 billion from the previous 1.5 billion limit per offering. Now, what does this all mean? This overnight repo operation is a tool that many central banks are using just to keep liquidity conditions working well in markets. And as the Bank of Canada put it, it's to support the effective implementation of monetary policy by intervening and injecting liquidity intraday into the general collateral overnight market to reinforce the bank's target for the overnight rate. So it's part of their monetary policy metrics, if you like, to keep where they see rates going and enforcing their rates, but really is keeping liquidity in the market so there's no stressful times. This may be something that's a year-end thing. While they're doing it this time of year, we can see liquidity conditions drying up. But also the effect of hikes coming in the market can put pressure on bond markets and the like, which then gets reflected in others like interest rates, collateral markets, that sort of thing. So as all these central banks start hiking, we can expect them to keep liquidity options on the table to make sure that there's no wobbles going on there. Over in the US, we had the NHAB housing market index dipping further to 31 versus 32. Right? Yeah.
Yeah, are you supposed to show data screen, or are you still?
No, there's only a couple of bits. I didn't bother. I haven't bothered this time.
Yeah,
Yeah,
because
that's only.
Brad is panicking. So
Oh, is he? Oh, Brian, go and get. You know where the calendar is, mate. We've only got about 5 of them on in the chat room.
I'm joking, Brad. I'm joking.
Yeah, of course we are. Of course we are. Merry Christmas, Brian. Yeah, so that was housing market index showing further weakness there. North Korea has threatened to take real action on Japan's ambition. This is to do with the fact that they see Japan's preemptive strike capability rising and causing more tensions there. So little fat boy rattling his saber about that. Elon Musk, he lost his poll on whether he should resign, and now there's some questions in play as to whether he's actually going to follow through with that. He might already be moving the goalpost by saying that from now on, only people with the white tick and the blue check mark will be able to vote in polls like that going forward. But yep, he got voted out by the punters. Over in Russia, Putin went to Belarus for a meeting, and a lot of people were thinking maybe he was gonna get them to join in the special operation, but RIA reporting from the Kremlin said that those rumours were groundless. In gold, Citi are bullish gold for 2023, especially the second half of 2023. They expect an average price of 1900 by end of year. I assume that's end of year next year. Michael, gents, you have a second? Would love to hear your view on what this BOJ widening curve means. No, I don't think we'll talk about that today, Michael. It's Christmas. I think we'll leave that alone. No, right, let's go on to it then. So they increased the band on the YCC target to plus or minus 0.5%, basically doubling the curve or the control band there. They said they modified YCC to improve market functioning, and they will also conduct additional bond buying on December 22nd, and they're going to increase JGB buys to 9 trillion yen in the first quarter of 2023. Now, Bank of Japan's Kuroda was obviously out in his presser with all the details. Very strong to push the narrative that today's decision is not a rate hike, and that the decision on the YCC is not an exit of yield curve control or a change in policy. And the decision was made today as deteriorating market functions could threaten corporate financing. And it's not very likely that market calls for another hike of the yield cap maximum limit. So it doesn't see the market coming back for more. As we know, they've been pushing and pushing at various stages in the Japanese bond markets for this very reason, and but he doesn't see them pushing again, apparently. He says it's appropriate to continue easing policy, and this was, again, the pretty strong message he was giving out, that they are going to continue easing. It's too early to debate an exit from the current monetary policy, won't hesitate to ease monetary policy further if necessary. Overall inflation is still not likely to reach 2% for fiscal year 2023, and there'll be no adjustment of easing without a CPI goal in sight. Talking more broadly, so it doesn't expect global interest rates to accelerate further. Obviously didn't get the message from ECB's Lagarde, and that US inflation rate has clearly passed its peak, something we don't know perhaps. It doesn't see the need revising the joint statement now. That's the government framework and all that sort of stuff talking about there. So a big surprise from Captain Charisma just before the year end. We said the risk was small, but a risk is still a risk nonetheless. And as you can see from the price in dollar yen, that small risk translated into a big price move. So what does it all mean? Is this the start of a tightening of Bank of Japan's policy, or have they just let some steam out the pressure valve for the YCC? Personally, I would say this isn't necessarily the start, though it could well be if the data keeps going the way it is, particularly on inflation. We still will not know really about wages until, you know, the end of the first quarter at least, going into the beginning of the new fiscal year. So there's still water under the bridge, and I think the Bank of Japan are going to keep on the easy side. But the market is going to infer that this is perhaps a first step. So from here on out, dollar yen is probably going to be quite a big rally seller. All JPY pairs are probably going to be fairly well bid from now on in. So I don't think this is a huge change in terms of monetary policy from the Bank of Japan. Obviously, you could say that looking at the moves, it's obviously big for the bond market. Still yet to be decided whether they are going to change policy across the board. So right now, sitting here, I just think they're letting off a bit of steam out their bond market for now. What do you make of it, Kay?
Yeah. Okay, as we said, right, and as I said a couple of times, it would be a surprise move, but if the move comes, it would probably be good for 400 or 500 points. And I didn't think that we would do those 400 points in less than an hour's time, though. But it shows how the market was positioned, not only locally but even internationally. Because if you look at the side effects that it had on global markets, and that's what I warned about that already a few times, is that the side effects of when the Bank of Japan will move could be relatively big, and we've seen exactly that. Somewhere, Bank of Japan, by buying all those bonds and the yen being relatively cheap to invest in, now has taken a part of that cheapness away, right? Because where you were guaranteed to only pay 25 BPs on for a 10-year bond, you now have to pay up to 50. So that is one thing. That is one, and the side effect of it is that we have seen literally in the minutes after they decided to hike the rates, we have seen all non-Japanese bond yields creep higher as well. So it had a big impact, and we warned about that. Now, what I think about the decisioning going forward, it is possible, and we've already said that before, that Kuroda, well, last time he made the big surprise was at Davos, right, in 2016. That was when he really surprised bigly, and that was the opposite when he went into QE and YCC. And this time he's letting the leash go a bit because there was a lot of issues in the bond market. There was they own more than 50% of the JGB market, so they had to do something. Now, we also said that it would be a costly affair to either raise rates or even widen the band. So I'm seeing the comment here of of what George saying, that they could now pull back that money home. I don't think they will pull all the money back home, because still, if you are imposing 0.5% max, and where the rest of the central banks, including the buddies, which were those who kept the yields as low as possible for as long as possible, ECB and SMB, they are now on the hiking path too. So I'm not sure that all the money will flow back home, but they will have to pay for some JGB losses, and that could be a pretty hefty amount. So yeah, when you hold your foreign bonds, you might need to repatriate some of that cash, and that is likely what we have seen as well, pushing the yields out elsewhere. Now, again, coming back to going forward, I don't know what really the outcome will be. Is he preparing the terrain for his successor to have an easier task to let the zero or negative interest rate policy go? Possible. It's a first step, right? And as we know, the local banks, the regional banks, are suffering as well due to these negative interest rates. So it could be the path to something bigger, and that is, I think, why the yen moved that much in such a short time, and has difficulties to dollar yen, for instance, which is the main instrument, has difficulties to recover right now. He's fighting back against the fact that it's going to be a big move, but the market is the market, right? The market will now start to anticipate that bigger things may be coming towards the fiscal year end or at the start of the new fiscal year. That's what I was saying yesterday as well when Stelios, when we were talking about what could be one of the currencies of the first quarter of 2023. Well, I said the yen could be one of the first quarter 2023 because the market will anticipate some changes, and here we are. Kuroda must have listened to the Flow Show yesterday and decided to anticipate our opinions a little bit. So yeah, for me, it's still going to be a slow process. It's not a guarantee that his successor is going to really let all the leash loose. I still think it's Japan. We can't forget that the government needs also to borrow a lot of cash, and that the economy is not really taking off bigly. So once this big wave is done, I would say be still on your guard, because it's not a done thing that Japan is going to move quickly out of. We could go to zero or even slightly positive rates to give the regional banks and the savers a bit of a breather. But if we are going to go on the same path as call it already on the S&P, I'm not sure, right?
Yeah, exactly, mate. I mean, it's also worth noting. I mean, a lot of people are probably going to speculate about the losses that the BOJ will incur, because obviously the value of bonds has now dropped. But it is only a book loss unless they decide to sell out their holdings, because it's only what it's valued as on their account. So in actual losses may not occur if they let all their bonds mature over the next, well, talking Japan, it could be the next 50 years. They're not going to suffer any actual losses from their bonds. What they have been probably hit on, though, is their ETFs and stuff. Is that going to be a big effect for them, Kay?
Well, they have, and actually earlier this week they did buy some again, right? But it was the first time in a long time. But as you say, it's just a book loss. Look at S&P. How long was the effect that when S&P declared their billions of losses? Swiss franc barely budged on it, right? So I wouldn't. Well, from a trader's point of view, I wouldn't trade it. And as you say, a central bank won't lose money until they effectively take the loss, which they will probably never do, unless things go really wild into negative and the economy completely collapsing. Perhaps then they can start to sell bonds, but then they will probably have cheaper rates. So no, I really wouldn't hang my hat onto it. And then I just want to comment on Gavin's comment there. Somebody tweeted, Bank of Japan moves up the cost of capital and ups the probability of an ongoing credit event. We always talk about credit events in whatever crisis, in whatever central bank moves going on. Yes, there are there's some kind of stress, but as we have seen, for instance, Yellen and Powell, they know it, and they are already seemingly on top of it. So I think it may impact more what other central banks will be doing than really the Bank of Japan in this event. Although yes, they up the cost of global capital, and I can't disagree, but I don't see from this move of the Bank of Japan a credit event unfolding directly. I don't see it. And we have to also know that in the reverse repo, there is, and okay, we can talk about different accounts, but there is an absolute pile of cash still in there because they get free money from the Fed right now. So money market funds could actually use those to alleviate some of the credit stress if corporates would need it. But it's a bit of a cloudy situation, I must admit. I'm not an economist, but from where I sit, I'm not sure that we can already attach the Bank of Japan move to a credit event. That's just my personal view, of course. What it can do, though, is because we are at the end of the year, is accelerate some liquidity, perhaps issues, which also indirectly may of course weigh on credit. But I think I'm more worried about a possible liquidity event for which the central banks have reaffirmed their swap lines in place. But we have to take into account that this is now possible since all central banks are raising rates. So that about this credit thing is not my base case, but again, I'm not an economist. Perhaps Ryan has a different view on that.
Yeah, I mean, no, I agree with you. You know, as mentioned with the Bank of Canada and their repo operations, you know, increasing the numbers there. Central banks have this sort of areas covered now. You know, they came through all that through the GFC. They put the tools in place to mitigate that risk. You can't mitigate everything. Look at the Bank of England and the mortgage stuff and the pension stuff that went on there. You know, you can't mitigate everything, but the tools are there now that they can jump in really quickly and calm the situation and fix any problems like that. You know, we're in a different world now. So yeah, I agree with Kay. I don't think there's anything like that. And to further add into what Michael's just asked, can this action affect the JPY's so-called safe haven status and decouple that relationship? Again, let's keep it all in context, okay? They've just moved the band 25 pips, okay? Not 100 pips, not 200 pips, not a huge amount, 25 pips, okay? They're keeping policy as is, okay? So while in Bank of Japan terms, this is a big move because they've done nothing for so long, keeping policy as is, you have to look at it in its context, okay? They're going to continue with their monetary policy easing as far as we're concerned, as far as they're concerned. So this is just, in my opinion, still just letting off some steam in what we've seen the market pushing against their narrative and against their band. We won't know whether this is a complete change of, or the start of a complete change of policy, but we'll know as we watch the data and as we listen to the Bank of Japan further. But for now, they're adamant things are unchanged apart from the curve. So does it change everything else? Does it change their safe haven status? Not at all. Does it change everything that Japanese investors are going to do wholesale? Not at all. There's going to be some obvious adjustments being made in assets and allocations and investors and that sort of thing. But you'd have to assume that the Bank of Japan have got that covered anyway to keep it from getting out of hand, anything like that. So big news, small move. Look at it that way in terms of what it means actually.
And if I may just add one word to Ryan, what you said is absolutely correct. Yeah, as you say, it's actually not a big move. And let's also listen and read what Kuroda said. They had to do something because, and we know that because a lot of people have already complained or were complaining about it, because of the risk of malfunction of the JGB market. And the JGB market, it has been said for months, was dysfunctional because only Bank of Japan was having too much of those JGBs. So somewhere we have to take some of the comments, even though we can speculate it's the start of something new. But we have to take some of the comments, at least at face value, saying that we had to do something because the JGB market was dysfunctional. So they may, in the short term, in what we saw the past, what is it now, 9 hours, we can see all those moves, and we can see what it did to the bond markets all around, and the initial move on the equity markets, because this was the last central bank holding their hands still, and now they are on the move. But let's not forget, they didn't change anything about the base rates, and they just want to reply or respond to a dysfunctional market. So and also, Michael, the yen's so-called safe haven status, since the central banks globally have been on the move, there's been a big decoupling, right, of what the yen represented as a safe haven status. Because let's not forget, if when the yields were going up, and especially in the US, the 10-year yield was going up, the dollar yen was flying, the equity markets were flying because there was still so much liquidity in it. But then, since the S&P, for instance, after hitting its high, came down 20% before the dollar yen even capped, before the top of the dollar yen. So this safe haven status of the yen, I don't know whether it's actually going to recouple in the next year. I'm actually taking it from the other side. Is it going to recouple? Because the decoupling has been extremely clear, and dollar yen went down for a couple of reasons. You had the interventions, first of all, and then you had the big setback in the dollar yields, especially the 10-year, because that's the main instrument the Japanese invest in. And you had the dollar 10s coming back from 4.25 to 3.40. That's a big move. So that is what drove the dollar yen or the yen over the past year and a half, not really the equity market. So will it recouple? It's possible, because it's still an ultra low yielder. So in some respect, it's possible that the yen regains some of the safe haven status. But I think in current context, let's the year end go by first, and then we will see what happens in the new year with equities, with yields, and everything.
Yeah, and you're 100% right. When you talk safe haven status, it's usually where money moves where it feels, as it says, the most safest. Now, that's all usually in big country bonds, because they're the safest, one of the safest assets around. US Treasury is always going to be a safe haven status. So when you're talking safe haven, you can go into US bonds now at 3.5%. You're going to get safety and yield. So, as Kay says, a lot of things change now. We haven't had a world with high interest rates for was it maybe nearly 15, 20 years now. It changes the whole dynamic of what safety is now, and value is for investors, and where people go when they think times are going to be stressful moving forward. So this isn't the same market we've had for the last 15 years. We're going into a different world of higher rates, and that brings different complexities with it. But let's get down to a bit more basics. How do you trade dollar yen now? Okay, we've had this big news. Okay, the market's reacted. Now, when I trade, I'm always looking at what can go wrong, not what can go right. I've been bearish dollars for a while. I've been bearish dollar yen for a while. I was short all the way up to near these highs previously, got out on the intervention a bit early, probably could have held it, but you can't trade backwards. I've been short various times all the way through, either hit on my trailers or got out of profit. I was short into this. And if nothing had happened over the Bank of Japan today, I probably would have been looking to get out and reinstigate shorts in the new year. And my reason for shorting, wanting to be short dollar yen, is obviously my main dollar bearishness, but also this pair has run a long way. You know, it's come so far so hard. And, you know, we've been saying for months on the Flow Show, this is the time when the Bank of Japan has a great window of opportunity to change its monetary policy. So that's always been a little, not the main driver of the trade, but that little bit in the back of the trade, the back of my head to say, if they ever did something, then this one, because of the way it's gone up, has a chance of coming down just as quickly. And, you know, we can see that. So what do I think now? You know, I've had a big move. I've taken some profit off 132.90s, 89, I think I took this morning when I woke up. How do we trade it now? Well, the risk is now, you know, now I've had time to think about it. This is a big move in terms of news and how the market's going to take it. It's not a huge move in terms of overall Bank of Japan policy. So they're going to continue easing. That means there's every chance that this can bounce back again once the market's got over this little part and understands what the Bank of Japan's actually done. There is a potential reason to see it move back up again. That's my risk now. On the levels, I think, you know, this 133.30 down to 00, the fibs down here. No, this was a big area I was looking at before. If we were to get a move down, it's obviously got blasted over the Bank of Japan. But as you can see, after the initial move, where did we find resistance? Right back in up here into that old low. And now we're finding resistance coming in against the level. So this 133 area is going to be my marker for now. I think rallies are going to get sold pretty swiftly. That's going to be the sort of area that needs to hold and where the rally sellers could come in. If we get above there, if we get above this prior low 133.60s, 70s, then maybe we could see a bit more of an unwind, maybe up to 134s. Can't rule out, as usual, anything going on this time of year end. But anything big rally that comes on that looks like a year end stuff, you know, back up to 136, 137s, I'm going to be looking at to add back into the position, because I think this is the type of move we could see continue when we get into the new year. So as I say, you've got to always look at the risk for the trade. Yeah, I'm in some decent profit down here. What's my risk now? My risk now is that we see a reversal, gets above the 133, 133.60 area, and then it perhaps chews up some of this move we've seen this morning. On the other side, where can we go from here? Let's just bring it out a little bit, if I can bring it out far enough. So let's take it onto the cleaner chart, might be a bit easier. There we go. So my next area is down at this 131s, probably around 131, 20, 40-ish, maybe up to 50-ish. The reason why it was a big level on the way up, let me make that a bit clearer perhaps. Let's have a look there. So this 131 area, here we are on the way up when we had the break up through the big 114, 115 area. Pretty much ran all the way up here. That's the first area we found a bit of resistance, decent resistance, double top there before we then had the move up. Immediately after that move, boom, support. Then we had another test, support. Okay, we had a breakthrough by quite a few pips there in the summer. But again, then we've held it again. So this is a big line, okay? Big area here. If we get to that, that's likely where we may see the price pausing, unless we get any big news coming out of there. If we do, then we could, you know, easily possibly head back up to 136s, maybe even 138s on a bounce from that. If we break there, we could see some further significant losses, and we could be getting back to the mid 120s perhaps. I would think 130 will be shortly after that. So that's my next big line. It gives us a bit of a decent range here, 133s, 131s, to see what happens into year end, see if anything develops from there on in. If we sit in that range coming into new year, I would expect that 131 to be under pressure early doors, and then maybe we get a further move down. obviously we're looking at the US data and everything that goes in the mix with that. What are your thoughts for dollar yen from here, Kay?
Yeah, yeah, your levels are spot on there in the 131s, and then 130 around, which is our what is it? May also low before the big jump to the highs when we went down from the move. We went down from 139 to 139 is around 130 and a half.
Yeah.
Somewhere there. Yeah, that's going to be a big level, bit of a psychological level as well, around 130. You know what? I mean, I've really only traded it, and the people in our community can go to the trades room. My trades are visible in there. I've just copied them, what I did over the Bank of Japan, but I haven't got anything in it right now. I mean, there's another reason is because I'm going to take a few days off, but I also am in a bit no man's land what my opinions are about the yen from here. Short term, we can also not forget that we are in year-end territory. There could be anything going on right now. People may need to buy billions of dollars. People may need to sell billions of dollars. I haven't really got a view on it. So we are going to be dragged around by year-end flows. Now, on the fundamental side of things, as we've already been saying, it's not a huge move compared to what other central banks are doing. We have to look at the fundamentals in Japan. They have been up and down at best. We are not in a situation where the Japanese economy is all of a sudden in a very bright spot. We can't forget that the government is putting stimulus package after stimulus package, and we are still the interest rates, short-term interest rates, are still at zero or even minus. So fundamentally speaking, for me, there's not too much reason to buy yen, but again, the big uncertainty is what's left to do in crosses yen, not only dollar yen. If you look at the rest of the dollars today, they haven't moved much. And if anything, from the initial reaction where the dollar got hit versus several currencies, and I'm looking especially at the commodity currencies and the cable, for instance, they had a very, very short-lived rally versus dollar, and then got smacked down because there's a lot of cross yen in the market as well. So the dollar yen is going to be dragged around by several factors. I think fundamentally there's not too much of a reason for it to go, let's say, below 130. But positioning-wise, this thing could go anywhere. I mean, really, if there's still a lot of yen crosses to be sold, any rally, and you spotted the one there, yeah, in the low 133s. And then call it prior lows and bounces like high 133s to mid 134s, and we have to look at it that wide because it's been that volatile. They're probably going to attract sellers, if not purely in dollar yen. They probably will attract sellers in crosses yen as well, because whatever happened, even though the move is not that big, it's been a little bit of a shock, right? So I'd be surprised if dollar yen recovers 135, 136 in the next sessions. But I won't be surprised if we find bids in dollar yen lower down, but the rest of the dollar pairs could be a little bit trapped due to yen crosses. So the view is I'm very happy to have taken, because I had like a stop entry just below 137, which was, I was so lucky to be done so close to my stop entry, because usually when there's a big decision, you don't see your stop and it just goes drops a big figure without even being done. But the market only saw the YCC widening very late compared to all the rest. And the first lines were no change, so only afterwards. So the market moved very, very, very slowly at the beginning. I think 15-20 points or so, that's all. And then all of a sudden when the YCC thing came out, it collapsed 2 or 3 big figures really quickly. So yeah, for the time being, I'd say it's tough to say even watch the levels for now, but I think 130 will be psychological because it was the big springboard from where we went up to the highs. And on the top side, I think, yeah, anywhere it should stay below 134.5, something like that right now. But then what's going to happen on the crosses? That's a different thing. There's some big levels around 140 in the euro yen, and we are not too far away from it. I don't know if you have on the daily, the 200 is just at 140. So you see the one coming up there is just there.
Yeah.
And also there's a Fibonacci from that latest from the 2022 move, I think, up to the highs. I think the Fib comes in around 140.40 or somewhere. No, it must be the other move then. Oh no, I think it must be the 78 point mumble or so.
One of your one of your funny ones.
Or the 23 point mumble. Yeah, I mean it's also just above 140. But I think I advise people to look at yen crosses, like Gavin said, 160 in the sterling yen. It's look at sterling crosses for what's going to happen as well. I know people mainly look at the dollar yen, but look at the yen crosses, because there may be some stuff to be done there, because investors, whether they be in Europe or anywhere, they will have, like asset managers, they will have a piece of this, piece of that, piece of something else versus yen. So yeah, keep an eye on those crosses as well. So yeah, for me, base case for now is that we can extend this move, but I think, in my opinion, once the clean out is done, range is more what I'm envisaging for the yen pairs right now.
Yeah, thanks, mate. And we need to be aware that the yen is having a big pull on other pairs as well. As we can see, Aussie dollar, big move down in Aussie yen. That's helping drag Aussie dollar down. Now we're back. Let's go into the shorter term. So we actually had a move through that zone, bit of a big flip around there as well. Obviously the RBA minutes coming out as well, but big move around there, blasted all the way through my zone there, but we're back above, but fading as well. So, you know, this is a time when you may be trading other pairs and looking for the influence. The influence is quite strong in the yen here, and that's going to pull a lot of the other pairs around. But then that gives you potential opportunity. You know, one thing we were going to talk about today is, you know, views going into 2023. I think the biggest theme to look at going into the new year is, again, one of central bank divergence. Just where different banks are now going at different speeds, slowing hikes. Some are taking a higher hike path, like the ECB, going more hawkish. It's still a very mixed bag of what central banks are doing. You know, last year or early this year, everyone was pretty much moving in the same direction. They still are, but things are calming down. Some are slowing, as we mentioned. Some might be looking to stop. So the divergence is going to come back into it, and the divergence is going to come back in probably in a lot of crosses rather than the majors versus the dollar. And you know, Aussie Kiwi is probably one of the big ones that's showing that divergence at the moment. You know, it's been a big move down, and this has come while the RBA has slowed and the RBNZ were supposedly slowing, and then they've ramped up again. So these are the sorts of trades that perhaps we're going to need to be looking at going into 2023, these different changes in monetary policy and what it means for things like the crosses, rather than versus the dollar. Obviously, the dollar is going to be the big currency like it was all through the past year or so, because that's one of the biggest central banks. But I think we're going to see a lot of this coming in some of the others. There's a reason why euro dollar's now, continuing to push higher, staying on its highs after the big bounce. This was peak Fedness down here. Now the ECB have turned. The Fed are are potentially slowing, the ECB are turning the other way, you know, euro dollar's probably still a buyer, and it'll probably be still bid going into the new year. Maybe could be the currency to be on if US weakens and the Eurozone keeps going, or the ECB keeps going. So that's one area that I'm thinking for next year. Kay, you got any thoughts?
Yeah, I mean,
going in.
Okay, I mean, the thing you say is right. There's going to be central banks being traded, but I think there's going to be, going into 2023. Besides that, which will attract a lot of money, of course, because that's what the market is trading. But I think besides that, there are going to be a few themes as well that we have to look at it on the geopolitics, on the macro level. So I think for me, two big themes for 2023 are going to be: are we going to have a grand recession coming globally? Yes, we have seen data slowing, but as we have already repeatedly said, they are not completely falling out of bed right now. Yes, we have seen some reactions. Equity markets are finding rallies, sales on rallies, and tech levels have been holding, and we have seen quite a bit of a hammering of the Nasdaq, for instance. But that's not yet your big recession trade, because a big recession trade, and let's say it happens in the US more than anyone else, would be a lower dollar plus lower yields. And we have seen this dollar from peak Fed hawkishness and from peak US data, but the big theme, the big question about, are we going to see the grand recession or even globally? That's still, to me, an open question. So data will guide us there, and one of the themes of 2023 will be, in my opinion, that one, and that's going to affect a lot of global assets. And the other one, the big question mark for 2023, in my opinion, and where we know that because it's the biggest trade market, right, that there is out there. Are we going to see the big China, the grand reopening of China, or is the virus going to literally, unfortunately, kill it in its early stages? We've seen again overnight a couple of attempts to soften rules in 6 Chinese cities. Hong Kong as well is trying to soften the rules a little bit. But we are far from the grand reopening, and that could be one of the big 2023 themes as well. Because if you have a grand China reopening, assuming that it's possible, a lot of the other themes will be pushed aside, because there's going to be a big reopening trade then to be done, and China will CNH will strengthen, but it's going to affect a lot of risk. Is going to affect the commodities. It's going to affect everything. It's going to affect the metals. It's going to affect everything. So those, to me, are two grand themes that we should keep in mind for 2023. And then there will be other movers on the side. It's non-exhaustive, of course. But as you were saying, then the CB divergence, are we going to see the big pivot in one to the dovish side? Are we witnessing the start of the big pivot to the other side of the Bank of Japan, for instance? Are we going to see ECB do what they say and continue with what Lagarde has said, 50 BPs hike for more than one meeting, which should put, and I think which should put euro crosses higher. Yeah. And I mean higher at the start of the year. I mean not just your 1.5%. I mean higher. Stuff like if, for instance, it goes coupled with the China being reluctant, stuff like Euro Aussie, Euro Sterling, Euro crosses can go really quite a bit higher if that's the case. But again, that is under the condition that we don't see the grand recession, because the grand recession, if it comes, it's going to be a right old mess. And for people who haven't been in the markets for too long, have a look at what happens in 2008. Have a look at what happens in the 1970s or so, when central banks raise into recessions. It can get absolutely messy out there. So those for me are big themes. And then, of course, the other unfortunate theme that is lingering is the situation in Ukraine. But sanguine as the markets are, it's traded less and less. Yes, we have those European caps on gas prices, which is an absolute joke. And we have other stuff in place. So the market is trading it less and less, but it's still a lingering risk factor that's going to be traded in the markets, but it might be just unfortunately for them, and really we have to think in this period about all the lives lost.
Yeah.
But the market is not being sanguine as it is. It's not too much trading the Ukraine situation right now. But we have to. We cannot just forget about it. Okay.
Yeah.
So that, I think, are going to be kind of the themes going forward in 2023, and then from there on we will drill down on them to see whether the data support one or the other big theme. So we're going from the big picture, will be gradually coming down to more close to us, facts and data, which will drive the big themes possibly.
Yeah, I agree with you. It's going to be, the global recession picture, but we should also know that two things. Just because everyone goes into recession doesn't mean it's a bad thing, or recessions are bad, but it's the scale of them. If the US posts minus 0.2 growth for the whole of 2023, that's not going to be bad, because it's going to be quite a shallow recession, and something like that doesn't mean the end of the world. And we're also going to be trading again the cleanest shirt in the laundry basket. So if the Eurozone goes into a minus 1% recession and the US is only on minus 0.2% recession, they're going to get the inflows again, because that's where investors are going to go, because it's the least dirty shirt. So exactly the same as how we were trading on the way up and all through last year, we're going to go the same way. So recessions don't mean we're going to end up in financial crisis or anything like that. And Ivana makes the point there. A recession could be redefined as a new normal. That could completely happen. I completely agree with that.
Yeah, absolutely. I mean, that's what I meant by, are we going to see the grand recession or
yeah.
And as I was saying, the data are slowing, but we are nowhere near a catastrophe scenario right now. And again, I repeat, sanguine as the markets are, if we only see a shallow recession, let's assume that we have got the global one. Okay, we've got those 1-2 quarters, whatever, like slight minus. You're going to see algo moves on that. But if you look at global assets, they might actually do pretty well, because market and money has to be invested somewhere, and there's nothing that asset managers, money managers hate the most, is to park their money in cash. They want their money to go to work, to make money, to beat indices, to beat other asset managers' revenues, because they want to attract cash as well. So I mean, as Ryan rightfully said, I mean, a shallow recession could actually turn out to be good for assets.
Yeah, very much.
It's only in the big grand recession thing that we have to look at those past years. And that's where we as traders and we who have been in the markets for a long time, we know that, because we have swam through multiple recessions and wars and stuff like that. Always remember what happens during other recessions, because history might not always repeat itself, but tendencies look very, very much alike.
Yeah, the effects of it do. And that was going to be my secondary point here. this is US interest rates. Now, if you're under 30 years of age, or 30 or under, you don't know a world really of interest rates when they were running, up at 4 or 5%. We've had 12, 10, 15 years of low interest rates. If you've been trading less than 30 years, even less than that, you don't know markets where interest rates are higher. And I mentioned it earlier, it can change the whole complexity of how assets perform, where money goes, where the flows go. So we all are going to have to get back to understanding what it means to trade markets with higher interest rates, because it brings a whole different set of things like risk conversation. Risk could change yet again. It could mean a different thing for stocks, how stocks move through next year. And as traders, you've got to learn to see the signs. Stuff that's worked for the last 15 years may not work next year. And you've got to look for that and factor that into your trading and understand the signs when they change, so that you're not stuck doing the same thing. You don't think, oh, bad set of data, buy stocks. That may not be the automatic response that's correct next year. Hopefully, with our guidance here on the Flow Show, we'll be able to spot those nice and early and let you know and say, this isn't working as it used to, and bring those changes to you. That's the whole point of us being on this Flow Show, to help you navigate these points. We've been here, seen it, done it. Doesn't mean, as Kay says, it's going to be a rinse and repeat. Things might be different, slightly different, but you tend to think when you get recessions, when you get interest rate rises, certain things happen in patterns the same way each time. We've lived through it. Some of you might not, and we hope to give you that guidance. Sorry, mate.
Yeah, and there's one outstanding theme that comes back in each recession, for one, in each period of interest rates hikes. There's one word that comes back, and we've already seen it during 2022. But if the rates continue to go higher, if this market continues to evolve, one word will be a constant, and that's volatility.
Yeah,
the markets will remain more volatile. If your interest rates are stuck to zero and everything is going according to plan, and look at how much the governments and the central banks have injected, asset markets were going on a rampage higher, and just going smoothly. Once they start to kick off with interest rates, have a look at what your markets have been doing since, and you will know that volatility is the one theme that is going to be a constant. And if there's one last word or one early word for 2023, my personal view is that volatility will continue to be there in 2023. The markets are not going to fall flat on their face. It's going to continue.
Yeah, you're right. Central banks kept the market suppressed. That line says it all there. That interest rate level says it all. They kept the market suppressed for so long. Now the cap's off the bottle and the genie is out. And as traders, we love volatility, as long as it's the right kind of volatility. Right, so on that note, it leaves me, as this is the last Flow Show of the year, just leaves me to say thank you very much for coming to the show and supporting us the way you've done in the months we've started and running this. It's been great fun to do, and no doubt will continue to be great fun into next year. But for now, it's time to call a little halt, have a little break, refresh the old grey matter, get set up for next year. We'll still be in the chat rooms, obviously. Between now and the end of the year, I'll be off more and more, just spending time with the family and whatnot, and I suggest all of you do the same. I want to say thank you very much to Kay, and I'll thank Stelios when I see him later. He's having another little Christmas business meeting, in inverted commas, let's call it that. Great input from the guys. It's been a pleasure to work alongside these people since I've moved to ForexAnalytix. It's been a pleasure to work alongside and trade alongside you guys and girls in the chat room and here on the Flow Show. So thank you to you. I'll let Kay have the final word, but just to say, have a very happy Christmas, safe and peaceful Christmas holidays, and a happy and prosperous new year. Kay, you can have the final word, mate.
Yeah, thank you very much, and thanks Ryan, and thanks to Stelios as well. It's been an absolute blast to start this show with you guys. It's it's fun, and it's even helping us talking about stuff, putting stuff out there. And I want to thank the audience to be with us every day. I hope we can help you a bit. So, and stay safe, trade safely, manage your risk over the year-end period. It's very important. Thank you all for being there. I wish you all a very, very Merry Christmas, and we talk to each other next year.
Yeah, thanks, Kate. RA's just asked when will we be returning. Keep an eye out for your email. I think it's possibly going to be the 4th. I think we're bank holiday here, January the 3rd. So it's either going to be the 3rd or the 4th, probably the 4th. But keep an eye on your emails. You'll get confirmation of when the next one is. And keep an eye on Twitter and everything. We'll make sure you know fully in advance. Thank you very much, everyone. Have a safe holidays. See you in the new year.